Hi everyone, David Maley here. Today I'm going to show you some really cool stuff. We're going to go and forecast with SPY. We're going to forecast the stock market and where it's going, and especially with what's going on nowadays, it would be important to see this and see what we can reveal from this. So if you look right here, we're looking at the SPDR S&P 500 ETF Trust, SPY. A lot of people use that to gear or gauge the stock market, and it shows pretty much it's the top 500 companies and investments like that. So if you look down here, it tells you the top holdings. You got Microsoft, Apple, Amazon, Facebook, and the holding percents change all the time depending on the value of that stock, and then they move them around to try and make them more even. But you can see there it's got, you know, a little bit of Google, a little bit of tech, a little bit of everything in their products, consumer products, Johnson & Johnson, Facebook, social media, and right now it's at 228.8 as of the close on March 20th, and you can see here in the past couple weeks it's kind of gone down quite a bit, 30% or so. And for year to date it says right here 28.24%, so pretty close. And I want to be able to predict that, but we want to be able to forecast it with a lot of data behind it. So I'm not just going to use the recent data. I'm going to use, if I click max on this, you can see this goes all the way back to 93. I'm going to use from 95, right about here. Actually right about there. Okay, so I'm going to use from 1995 onwards. It's going to include two recessions. The recession you can see right here of 2001 and the recession in 2008, that really deep recession, the Great Recession as they called it, that went on in 2008, 2009, and you can see here why it took all the way until 2013 or so to recoup from that. See that line straight across there? So it started in 2008 and it took all the way till 2013 for that one to recoup. This one, same kind of idea. It started in 2000 or so, 2001, and then it took all the way until the next recession, until 2007 to come back. It can take a while to come back from a recession. All right, so what we're going to do is I'm going to go into R, right? We're going to go into RStudio, and I'll show you exactly how we're going to do this. So what you'll end up in the end with is we're going to end up with 4 ARIMA forecasts. They're going to show you exactly what, with a 95% and 80% bands here as to, you know, what's that going to do. And we're going to give you 4 different ones. But I'm going to show you, so you'll end up with this in a little bit here. But let's start off first. What we're going to do is these are the libraries we're going to use right here. Quant Mod, T Series, Time Series, Forecast, and XTS. And make sure when you do the time series one, when you load this guy in, that the S right here is capitalized, called camel case, okay? And make sure you do that because if you don't, it will tell you can't find it. It's very specific, and R has to be exactly that. So let me show you this here. If you do not know where that, or if you don't have that library, just load it in by install.packages. And I'm gonna load this in here real quick to highlight this so you can see things a little bit better here. Let me get rid of that here. Get rid of that, and here we go. So that can show you a little bit better of where we are on this. Now, what I'm going to do, you've loaded in those libraries. We're going to pull 25 years of data, like I told you. So we're going to pull from 1995 to 2020 current, right? 321 is current. That's yesterday. Today is 322. And we're going to pull 25 years of this data of SPY SPDR S&P 500 ETF Trust. It's been down about 30%, 28 point something, whatever, from its highs. And we're going to pull 25 years again to incorporate numerous recessions, corrections, and other things. So we have more accurate data behind this. If I just pulled recent data, it would have a huge downturn and not a lot of upswing, and that might, you know, make it incorrect or have high variance. So we don't want that. Okay, so we're going to start off with here. Once you've loaded in the libraries, you're going to do get symbols, the function of get symbols of SPY, right? That's what we're going to pull back. And you can pick any stock ticker symbol that's publicly traded and put it in there as long as that data is in Yahoo Finance. That's where this comes from. This get symbols pulls it from there. It'll pull it back, and it'll pull back from the dates that it's available in there. Okay, so this is the command here, get symbols, SPY, comma, from 1995, the basically 1/1, which is January 1st, to current of 2020. We want to get the class of it. It's XTS Zoo. What that means is that you can't just readily read it and graph on it. So what we have to do, When it's zoo, what that means is XTS and zoo, that means that it's got multiple components to it, right? So if you were to look at a Excel sheet and you looked at, you know, like you might have date and an item type, but you might also have many other columns with it. So if you look right here, this has columns for open, high, low, close, and other things. We just want the day's close price, right? And the reason why is because if you got the open price or the midday price, it doesn't matter. What really matters is what did it close at that day. Okay, what was the final price of the day? It could vary huge one day. I don't care about the high and the low. I just want the end close price for each trading day. So that's the fourth column. So what we do is you put SPY underscore close prices, so we know what this is called, okay? And we're going to put the SPY comma 4, so we're taking the fourth column there. We want that. Then what we do is we plot that data. So once we've done that, what you want to do is you want to plot that data, right? So if you do this, hit Control and Enter, this is what your data is going to look like. Now, the problem here is, see how that's really small and kind of messed up looking here, and that could print out this whole thing? You have to use this to reset your screen, right? So it's parameter PAR of MF row equals C1 comma 1. Okay, so when you do that, what that's going to do is you're not going to see anything now, but it's going to take it right before this. It was set up to have 4 graphs on one page. Now it's going to be for ones. Now if I go back and run this same thing again right here, you'll see it bigger, much easier to see. You can see from 1995, which is what we put in, we got all the prices for SPY all the way through. We got 2 recessions in there, and we got the latest correction / recession over here. We also got one before it too with a downturn in 2018. There was a correction. So it shows you that currently we're below the 2018 correction. So now that we've done that, what we want to do is we want to look at the ACF and the PACF, because that's where we get our values for the P and Q for our custom ARIMAs. ARIMAs have a P, a D, and a Q value, right? So let's go through, there's 3 values. So I'm not going to go into everything. D is differencing, and then the P and the Q come from the PACF and the ACF lags. So let me go and put that in here. And what we'll do is start off with this. Remember now, before we did it 1 comma 1, I want to do it 1 comma 2. So let's do that. And then next, let's do this. And we're going to run them both, right? So they're both going to show up. So there you go, you got them both. And look what it shows. It shows these are all in row, and it starts with 1. So what that's telling me is that we have a what? A PACF of 1. PACF is what? Remember, the PACF is the Q value, or I'm sorry, the PACF is the P value, the ACF is the Q value, right? So they both show 1. So now if we go past this, what I want to do is I want to do a print of this, and I want to do the auto ARIMA, right? So this is all the code you're going to see right here is print ADF test in your SPY close prices, and then the auto ARIMA SPY close prices seasonal equals false. See that? So what that does, it shows you right here below, okay, 2 things. So let's go up a little bit. The first one is the ADF test. That gives you the augmented Dickey-Fuller test, which tells you your p-value, in this case is 0.4521, okay, which you wrote over here. It'll also tell you your lag order of 18, which you want to know that. Now let's go down here, and actually the bottom here, the part where we did the auto ARIMA of that, where seasonal equals false. What that does, it tells us what the optimal ARIMA value is 113 with drift. That's what it's telling us right there. And then it tells you the log likelihood and your AIC and BIC values. Okay, as they are large, which they are here, that tells you it's more accurate with that. Now, next what we're going to do is we're going to create our fits, right? So the fits are, in this case, fit A equals the auto ARIMA from above, exactly like it was. Let me open this up so you can see it's a little bit better here. Okay, so you've got the fit A, you've got the TS display, right, of 113, because that's what we just did, and the auto ARIMA. So by doing this, you run that, it's going to run it, fill it, and give it a second, and it gives you the values that you want. It puts it in here as a fit A. And then we're going to do the same thing for fit B, fit C. Well, so now fit A was the auto ARIMA. We're doing the same kind of code, but the difference is, remember, we had a lag order of 18. So in fit B right here, we're going to do instead a 1118. Now this one should say 18. Okay, but that's what we're doing. So it's 1118. Okay, I'm not going to run that right now. I've already done that, and some of these take a little bit longer. That one's not too bad, but the next one would take a while, and I'll show you why in a second. So now the next one, what I want to do, so I'm going to have fit A is the auto ARIMA, fit B is the custom ARIMA of 1118. We've taken into account the lag value. And then fit C is going to be 1238, and the reason being is when a difference of 2, and when we go and look at that, we want to have the last values. There's a point where it touches here. The other one will take care of all these lags, right? But we want to make sure that we take this one that touches it in the end of the 38 value and incorporate that. This one takes a while to run. It takes like 20 minutes to do that for a 38 Q value. So you can run that on your own and see how that works. And it's basically the same exact code. It's just we're putting 1238 in there. Then fit D, what I want to do is I want to show you, that's this guy right here. I want to show you what the generic default value is. So when you look at a thing like ClickSense, Power BI, any of these business intelligence applications, and they have a built-in default auto ARIMA model or ARIMA model, they will basically use a 111 in there to make it simple and easy. And I want to show you what that is so you can see how close or how accurate or how inaccurate that is. So then you'll run that one. So we're going to have 4 different fits, right? That's 4 different ARIMA models we're building in here. Then what we're going to do is we're going to take that, once we've done that, we're going to plot it for 100 days. Now remember, we're doing 4 different ARIMA models, right? So as I showed you earlier, I'm going to have 4 different graphs. So I have to use this guy right here, par MF row of C2, 2, right? So 2 by 2. So I want to be able to do 4 graphs. So let's do that. Then what we want to do is plot these. So let's do the first one of 100 days, right? So term is 100, right? And we're going to run that right through all 4 of these. So we got FCast 1, which is forecast 1, is the forecast of fit A, comma, H equals term, which is 100. I could just put H equals 100 for these, but then I've got, every time I want to change this, it makes it so, you know, you got extra work you have to do. You have to write 100, 100, 100, 20, 20, 20, 20, or whatever you want to do. Just put it here, you just change it one time right here. Okay, so it's just like using a variable. That's basically what it is here. So if I hit this and hit enter, it gives me his 4. Now that's for 100 days, right? So at 100 days, if I bring this up and make it nice and big, you can barely see it. And the reason why it's very small is we're not looking at, you know, a 1-year graph. We're looking at, remember we started in 1995. So this is 2001 range here, that recession. That's 2008, and this is the current downturn we have now. So from this you can see pretty much that one looks pretty straight, little downturn there, and then some straight and straight. So for the next 100 days, according to this, all 4 of these ARIMA models are telling me basically there's going to be pretty much stagnant, staying where it is, or a little bit of downturn left. Not a huge downturn, but some downturn left. That's what they're saying. So now if I go here and I say that was from 100 days, I want to see the accuracy on it first. So let's take it, the accuracy function on that, right? If I run all 4 of these, I have to open this up a little bit wider, and what we're looking for is something called MAPE. Now watch. And here I go more into these different values and what they are in some of my other videos, but here I just want to tell you the MAPE will tell you if you take that, you take 100 minus your MAPE score here, you get your accuracy. So 100 minus these tells you you're at 19.1918 whatever percent accuracy, which is pretty good. That's very accurate. Okay. That's how that works out for all these. So remember, forecast 1 was our auto ARIMA model. Forecast 2 was the custom ARIMA model. Forecast 3 was at a differencing level of 2 and the higher lag of 38, the final lag in that 0 through 40 range. And then FCast 4, or forecast 4, was the default 111 ARIMA model. Okay, and from there you can see usually the custom EMA will be the most accurate, but in this case they're all so darn close it really doesn't matter. And then now you saw above I did for 100 days. What if I want to do it for 45 days? I would just change the term and make it 45, keep the rest the same. That's all I have to do. Now for 45 days it's not going to show very well on that graph. It's going to be a little itty blue blip. Watch. So I bring that up. You can barely see. You can't even tell what that's doing. It does look like kind of straight down, down, downturn, and then an upswing. You know, it's very hard to see that though. If I did a smaller date range, you'd be able to see it a lot better. Very hard to see. I really can't make that a whole lot bigger here on my screen. But what we can do is we can look at a longer term forecast. What if we wanted to look at a year, 365 days? So let's do that. Now see how it's much bigger? You can see it, but that's a longer term thing. So obviously we just saw in the 45 days it's going to be most likely a downturn. In the 100 day, it's mostly going to be flat. And then if you look at a 1 year range, you've got one showing an uptick, long-term uptick, another one showing a downturn and then an uptick, downturn and then flat with possibly just going slowly down, and the other one looks kind of flat or slightly down going across. So you have 4 REMA models, right? We did it for 3 different periods. We could do it for as many periods as we wanted. We could look at a 2-year period. We could look at a 3-year period. Whatever we want to do there. But when you look at this, basically, you know, in the short term, what it's telling you is it's probably going to have a downturn still to it. It's telling you that at what is it, the 45 days we did. So 45 days most likely going to be a downturn. Next 45 days, that'd be next month and a half. Next 100 days, which would be their next 3 months and a week, would be stagnant. And then over the next year, you're looking at some uptick to it or stagnancy. So that's usually what happens with the recession, is it takes years, as you saw for the 2008 and the 2001 recessions, is that it can take 5, 6, 7 years to get back to what it was beforehand. So it's going to be you're going to see, you know, some downturn probably, and then finally a long eventual growth back over the next 4 or 5 years, maybe longer, depending on what it is. So that's how that works. If you want to look here, I put a little results section in here. This, and I want to make this important announcement to you, this is not investment advice at all. This is just using some data science, R, and some functions and some libraries in R to have some fun with predictions and forecasting of stocks, and in particular the SPY, which is the SPDR S&P 500 ETF Trust. This is not investment advice in any way. So there's a lot of factors out there, both internal and external, that can do and have a major effect on stock market values, trending, and more. Now, the results from this that we found is there's potential for some near-term drop, and for the next year to be a hold or possibly a little lift throughout the year. No need to rush out and invest right now, but again, this is not investment advice. I hope you found this interesting and educational. All the code I showed you was in here. If you want me to go back through it again, we can do that really quick. You've got your libraries, QuantMod, T-Series, Time Series, Forecast, XTS. If you don't have them, use install.packages and then the name of the library to load it in. Use get symbols function, which gives you the the information by stock ticker symbol from Yahoo Finance for as much dates as they have in there. You can pick whatever date range you have that there's dates or there's data in there. Then you go and get the 4th column to go and pull back the close, the daily close data. Then we used that, we plotted that, we saw the different recessions in there and stuff. Then what we do is we go and look at the ACF and PACF to get the P and Q values, right? And we did that. Then we did the auto ARIMA where we got the 113 value, the AIC, BIC to see how accurate it would be, and the lag order, which would be the Q value of 18. Then we used the auto ARIMA value in here. We pulled Fit A, which was the auto ARIMA value. Got all the stuff right here, TS display, showed it was what it was. Then we did the same thing for Fit B, but we did that with the custom ARIMA with the 1118. So you got 113, 1118. Then what we did was we looked at the last of the lags in the noticeable lags in the 0 through 40 list, which was 38. We did that 1 to 38. That's what that one is. Then, so that's got a differencing value of 2 for more seasonality to be taken into account, and a Q value to incorporate better fit. So then we also did a 111 for fit D. Then we plotted these for different terms, 100, 45 days. We saw the accuracy of it, and then we even did it for 365 days. So you had a multi-date look at it to see both short-term, longer-term, and 1 year. And that's basically what we did. So thanks again for watching. Please take a moment to subscribe if you haven't already. Like, share, and make sure you click that bell, because that way you'll get notified whenever I put out another great video like this. I'll do these from time to time so you can get a more up-to-date look from a data science perspective at the stock market and what's going on out there. Let me know what you like, what you don't like. Please leave me some comments. I love to get feedback from my audience, and I'll respond to you as quick as I can. Thanks again for watching. Again, please subscribe if you haven't already. Click that bell so you get notified whenever I put a video out there like this, a good, helpful video, an interesting video. And also take a look at my video channel, all the other videos I have out there. I got all kinds of great stuff. All kinds of stuff we actually use in data science and data analytics. And by the way, I am a data scientist at a Fortune Global 200 company with over 500,000 employees and over $70 billion in sales per year. So these are all processes and analytics ideas, and it's all done on real data. Sometimes this is not the same data. I'll take publicly available data because I can't use proprietary data to show you, but it's the same processes we use every day to better show insights, to dive into our data, to explore the data, and to massage the data and get our requesters, our companies, our executives the data they need so they can make decisions on that data. So these are real actual business applications of this or on all these videos that I do. So if you're interested in data analytics or data science or both, you need to be watching these videos. Thanks again for watching, and have a great day.